Two things happened on the same day that have never happened simultaneously in market history. COMEX silver crashed 31%, the worst collapse since 1980, and Shanghai silver hit an all-time high. Same metal, same day, opposite directions. That's not volatility. That's two markets that have completely separated from each other. I'm going to show you exactly why that happened, what it means for price, and why the math points to a number most people aren't ready to hear yet. Let's start with what the government just did, and more importantly, what they're deliberately not saying. President Trump signed an executive order creating something the US has never had before, a $12 billion strategic stockpile of critical minerals for civilian use. Not military, civilian. $10 billion through the US Export-Import Bank, $2 billion in private financing, all dedicated to securing materials that American automakers, tech firms, and manufacturers can no longer afford to source from foreign suppliers. They're calling it Project Vault. And the first thing you need to know is that the official mineral list hasn't been released yet. They haven't told us exactly what they're buying, but the White House's own statement confirmed that in 2024, the United States was 100% import dependent on 12 critical minerals and imported 50% or more of 29 others. Silver is already classified across multiple categories that fall under both critical minerals and strategic materials. Now, here's where you need to think like a government buyer for a second. If you're building a strategic reserve and you announce every commodity on your list, before you start acquiring, you move the market against yourself before you buy a single ounce. So what do? You build the legal framework, secure the funding, create the infrastructure, and then you go quiet on the metals you need most. You acquire before the announcement, not after. So when you look at Project Vault's public statements and notice silver isn't being mentioned openly, that silence isn't reassuring. It might be the most telling signal of all. And while the US is still building its framework, China already made their move months ago. On January 1st, 2026, Beijing reclassified silver as a strategic material, not just important, strategic. They now control who can export it. 44 licensed companies, that's the entire list. And those 44 companies control 60 to 70% of global refined silver supply. China saw something coming and positioned first. So now run the logic forward. China controls the majority of global refined silver. They've restricted exports. The US is creating a $12 billion reserve explicitly designed to reduce dependence on Chinese-controlled materials. What do you think sits at the top of that acquisition list? The metal that goes into every solar panel, every electric vehicle, every semiconductor, every 5G component, every military application, and the exact metal China just locked behind a gate with 44 keys. That brings me to something that should stop every investor cold, because this isn't government speculation anymore. This is a corporation with billions on the line making a decision based on hard data. Samsung, the world's largest semiconductor manufacturer, stopped using COMEX entirely. They didn't reduce their exchange purchases. They bypassed the exchange completely, went directly to a Canadian mine, and locked in a 2-year exclusive offtake agreement for 100% of that mine's output. Every ounce that comes out of the ground goes to Samsung before it ever touches the open market. That's not a hedge. That's a company that ran the numbers on available supply, looked at exchange inventories and lease rates and paper claims, and concluded the exchange doesn't have a pricing problem anymore. It has a credibility problem. They don't trust that physical metal will be there when they need it. So they went around the entire system. And if Samsung won't trust the exchanges, that's the question you need to sit with right now. Because when you look at what's actually happening inside those exchanges, the numbers explain everything. COMEX currently holds 108.7 million ounces of registered silver, the metal physically available for delivery, but paper claims against that inventory total 1.586 billion ounces. That's 14 paper owners for every single bar in the vault. And in the first week of January alone, 33.45 million ounces were physically pulled from COMEX. That's 26% of all registered inventory gone in 7 days, more than a quarter of available silver drained in 1 week. When that happened, lease rates, the cost to borrow silver, exploded from 0.3% to 8%, a 27x jump in 1 month. Here's why that number is the key to understanding everything else. There's an obvious arbitrage trade sitting in plain sight. Buy silver on COMEX at $80, ship it to Shanghai, where it's trading at $111, sell it, pocket $29 per ounce profit. Free money, right? Except nobody is executing it. Nobody is closing that 40% gap between New York and Shanghai, the largest sustained price divergence in precious metals history. And the reason is exactly those lease rates. That arbitrage requires borrowing silver to execute. When borrowing costs jump from nearly 0 to 8%, the profit from the trade disappears entirely. The economic mechanism that should naturally close price gaps between exchanges is now dead. The market cannot heal itself. So what you end up with is something that simply shouldn't exist in a functioning market. On January 30th, time-day COMEX crashed 31% to $78, the worst single-day collapse since 1980. The same day, the Shanghai Futures Exchange settled at an all-time high, same metal. Two exchanges moving in exact opposite directions simultaneously. This isn't a market anymore. These are two completely separate realities, one trading paper claims on a screen, the other trading physical atoms, and only one of those is real. Physical silver is telling us there's a shortage. The spreads are telling us, the lease rates are telling us, the vault drainage is telling us, Samsung's behavior is telling us. Atoms don't lie. Now let's get to the math, because this is where $562 goes from sounding wild to sounding inevitable. For most of recorded monetary history, gold and silver traded at roughly a 15-to-1 ratio. Through much of the 20th century, we saw ratios in the 20s and 30s. Right now, with gold around $7,500 and silver around $85, that ratio sits at approximately 60-to-1, meaning silver is deeply undervalued relative to gold by any historical measure. Multiple analysts tracking this breakdown are targeting a return to at least a 15-to-1 ratio. The arithmetic is straightforward. $7,500 divided by 15 equals $500. If gold moves toward $8,430 within range given central bank buying and monetary instability, and silver corrects to that same 15-to-1 ratio, you get $562. That's where the number comes from. Not speculation, not a gut feeling. Mathematics applied to a historical ratio reversion that is already being forced by the physical market breaking down in real time. Do I guarantee this happens? No, nobody can guarantee future prices, and I want to be clear, this is analysis, not financial advice. But is it mathematically rational given 14 paper claims per physical ounce, 26% inventory drainage in 1 week, a 27x spike in lease rates, Chinese export controls, and potential government buying competing with industrial demand in an already tight market? Absolutely. Some analysts are now calling for this revaluation within 6 months based on the rate of COMEX drainage and the structural impossibility of the current paper-to-physical ratio holding much longer. Whether that timeline plays out exactly, I don't know. But the direction is no longer in question. What you're watching right now is three forces converging simultaneously: a $12 billion US strategic reserve targeting the exact materials China locked down, with silver sitting directly in the crosshairs; a physical market that has already fractured, the arbitrage is dead; the two-market reality is here, and the paper system is hemorrhaging physical inventory it cannot replace; and a mathematical revaluation case where even a conservative return to historical norms puts silver at $500 to $500 to $562, depending on where gold settles. These three forces have never lined up like this at the same time, and the window between now and the official government confirmation, whenever Project Vault's full mineral list drops, is likely the last moment this setup exists at current prices. Once silver is confirmed on that list, once government buying starts competing with industrial demand in a market that's already structurally broken, the price you see today will look like the entry point you either took or missed. The physical market is already telling us the truth. The question is whether you're paying attention before the mainstream catches up. Drop a comment below, are you watching the same signals? And turn on notifications if you want to stay ahead of the next update. In a market moving this fast, being late has a real cost.